The world of annuities can be complicated, so complicated that Merce and I have not been able to handle explaining to you how annuities work in one show. And now we are bringing to you Annuities Part 4. How do the insurance companies provide the guarantees that they do? How do they provide you upside potential and also give you protection on the downside? We're going to cover that on the show today. We hope you enjoy. By the way, we love it. And I ask you, if you're at all possible in your life, to go give us a 5-star rating on whatever platform you listen to us. If you can give us a rating, we would love it. And if it's on iTunes, a 5-star rating as well as a written review, it certainly does help us out.
Before we head to the show, a quick disclosure so that we can continue providing content for you. The information contained in this podcast is intended to provide general information only and not to be considered individualized advice. Different types of investments carry different types of risk. Please contact your financial professional for advice appropriate to your specific situation. Enjoy the show.
Well, we are on today's podcast bringing to you what we are calling Annuities Part 4. Annuities is something that has so many different layers to it that we need to understand. There was no way that we could handle this in just one show, and so we've split it up, and now we've kind of got this series going of being able to understand the different types of annuities as well as how they work. And again, we're not able to go into an extreme amount of detail even within these shows, but we're trying to give you a nice overview. So being we are here on Annuities Part 4, Merce, can you kind of bring us up to speed what we've discussed thus far in the first 3 episodes, and now where we're going to go today?
Yeah, absolutely. So like Radon said, there's a lot to these, which is why we broke them down into a few 15, 20-minute episodes. But today, we're going to go over something new. But before we do that, I want to kind of take you through the last high level of the last few episodes. If you haven't listened to those Annuities 1, 2, or 3 yet, I would encourage you to go back and listen to them just so you have a better understanding as we move forward in this process. But first, I think it's important to understand the world of annuities, and I'm going to break it down very quickly for you. In the world of annuities, we have essentially deferred annuities that are basically tax deferred. And within them, they do have some surrender penalties. And what that means is that you're committing to an annuity for a period of time. Now, there is the old school version, let me say that way, of an immediate annuity where you essentially give money to the insurance company and they right away will give you an income stream. So you give them $100,000 and they may give you $500 a month for the rest of your life. So that's the immediate annuity. What we're really working on in these episodes is the deferred world. And in the deferred world, we have fixed and we have variable annuities. Variable, we're not really talking about here, but in that world, you can invest in the stock market within that annuity vehicle. You're typically buying mutual funds. There is risk. The market can go up, the market can go down, and so can your value. And a lot of the headlines you'll read about the variable annuity world is that there are some fees involved that can be a bit overwhelming. And the biggest thing is that you can lose money in these products. In the fixed side, which is where we're focusing on, you've really got 2 different types of annuities. You've got the traditional and you've got the indexed annuity. The traditional fixed annuity is tax deferred and it has a principal guarantee. So you can look at it in the sense of it's not going to lose any money and it comes with a fixed interest rate. So kind of like a CD. So you put in 100,000, the bank says we can guarantee you at this current point, probably 1% if you lock it in there for 5 years at the bank. A traditional fixed annuity is going to be very similar to how a CD works in that there is a fixed rate, a couple percent, 2, 3, 4%, whatever it is at the current time for a period of time, whether it's 2 or 3 years or 5 to 10 years. So that all fluctuates, but it's very much like a CD. In the indexed fixed annuity world, you are still tax deferred. You are still having your principal guaranteed, so you cannot lose money in this product due to any market fluctuations. And the way that you earn your interest is market linked. So you may be tied to an S&P 500, tied to the NASDAQ, the Dow, whatever it is. And whatever the index does, you receive a portion of that performance. And so that leads me to one of our previous episodes. We went into how you actually earn interest in a fixed index annuity. And so in the fixed index annuity, once again, we're tied to that index, and whatever the index does, we're going to have participation in that performance. So, and this is all based off of a point-to-point annual reset. So what that means is if I start the annuity in January 1 of 2020, and we're working off of an annual point-to-point, so you get January 1, 2020, you get down to January 1, 2021. Whatever the index does in the middle of that window is how your interest is going to be credited to you. Now, there's two different ways that we talked about. There's other ones out there, but the most common are you can have a cap or you can have a participation. So let's run some examples. A cap is basically saying that the insurance company is going to give you up to a certain point. So let's say the cap is set at 5% and you're still tied to that index. Let's just say the S&P 500. And let's say the S&P 500 earns 10% in a given year. Well, your cap is 5%. So you earn 5%, or in a scenario of $100,000 going into the annuity, you earn 5% and you're now at $105,000. And so we can go down the line. Let's say you earn another 5%. You've got 110,250. The beauty of the fixed index annuity in the sense of principal guarantees is that you cannot go backwards due to market volatility. So continue with that example, and you're in this annuity that has a cap of 5% and you're tied to the S&P 500. Well, let's say that the S&P 500, very much like it has this year, even though it's come back, but there was a period of time where the S&P fell as much as 32% this year. So if you're in the fixed index annuity environment, the worst you can do in an annual reset period is earn a zero. So the market, the S&P 500 goes down 20, 30, 40, 50%, whatever that number is, the insurance company is guaranteeing that you cannot make a negative return. So you earn a zero for that year. So that 110,250 that you had earned up to is still 110,250. Now that's the cap of 5%. One other example is the participation rate. And so it works somewhat similarly, but instead of saying at the most you can earn is 5%, the insurance company is going to say you can earn or participate in a percentage of what the index does. So it could be 50%, it could be 70%, it could be 100%, or even more. But let's go with an example of 50%. So let's say that the index earns 10%, you're going to receive 50% of that 10, so you would earn 5% in your fixed index annuity. Still working on an annual reset or an annual point to point. So remember, if you start January 1, 2020, you end January 1, 2021, and whatever the index does in between is how your interest is calculated. So that's a very quick, high-level overview of Annuities 101, what they are, the different types there are, how you can earn interest between a cap or a participation rate. And now what we want to do in today's episode is kind of take you through, because you may be hearing some of this and thinking, well, this just sounds really good. And what are the gotchas, or how does the insurance company actually, how are they actually able to do this? And so I'm going to pass it over to Radon, and he's going to walk us through what the insurance company is doing in the background to make all these guarantees and still provide you with a rate of return.
So thank you, Merce, for that. The thing that you want to keep in mind is, I think we've said this in the previous episodes around annuities, is as Merce is going through all this, you might think, well, why would I ever do an annuity? And those are great benefits that he just talked about. You earn a rate of return, you have some protection there. But the real reason why we believe that annuities are a good fit for some of our clients and for some people that are close to or already in retirement is really, it breaks down to two major categories. One is income planning, and the other is a safe money accumulation alternative, meaning I don't want to go into a bond. CDs aren't paying anything. Money markets aren't paying anything. So annuities give us an alternative to that. So keep that in mind as we talk through these strategies. Okay, so now you might be thinking, wait a minute, Merce just talked about, again, this idea, or if you heard the last episode and you're thinking, how, okay, I get it. So basically what most people think is if we have a cap, that means that if the cap is, let's say 5%, like Merce said, and then the index goes up 10, the insurance company gets to keep all that spread above 5. Or if let's say that the index is down, like Merce just talked about, so let's say that the index is down 20, 30%, but you've got a 0, does that mean that the insurance company is on the hook for all of that negative? And the answer to that is no and no. They do not make that spread if it's above the cap, and they do not lose anything or have to go on the hook, so to speak, if it's down. So how do they do it? Again, we know that this is in a setting where we can't show you slides or anything like that. So I'm going to give you a verbal visual of how it works. So in your mind, think of an insurance company. So you got this insurance company, and this insurance company has assets or dollars, premium dollars that different people have given them. So you've put money in with that insurance company to have an annuity. So you put in whatever that is, $100,000. Now those assets are now going to be managed by the insurance company. So now let's just do things so that we can visualize it. Let's say that this insurance company has collected $1 billion. That would be, by the way, a very small insurance company, but $1 billion of assets that they are investing to make money on. So now, if you go to that first scenario Merce talked about, let's say that on those assets, they're earning 3%, and they want to keep some of it because they need to make a profit. So they tell you, if you put your money with us right now, we can guarantee you 2.5% on your money. And you go, well, that's okay, but not that attractive. Well, what the insurance companies did is said, how could we offer our clients, our policyholders, maybe more potential for income? So what they did was they said, would you like the 2.5% up front? And you say, well, that's not that great. Is there anything I can do better? And they said, well, we could take that 2.5% that we were going to give you, but we could go buy what is called a futures contract. Now, think about a future. Just think about the terminology here. They're going to go buy a contract that says, if in the future, this index, so let's just talk the S&P because it's just a well-known index, is up, I get to participate. But if the index is down, we basically get nothing. So it's like buying this contract or this insurance contract actually against this index. So the way it works is the insurance company puts up the 2.5% they were going to give you anyway, and they buy this futures contract. So let's now say that the futures contract, whoever's going to give this, says, hey, you give me 2.5%. If the index goes up, I think that based on those numbers, we could give you up to 5%. That's our cap, okay? But if it goes over that, we can't afford to give you anymore because that's too much risk. We don't know what we can do with that. So the insurance company says, hey, if that's the most we can buy, that's the most we can buy. So they buy that. And now the futures contract, if you might want to say, it expires at 5%. I get my 5%, and that's what I've got. If it goes above that, the insurance company's not participating. That's on the person who issued the futures contract. Same on the other side. They give them the 2.5%. They put it toward that contract, and the index is down. If the index is down, then the insurance company's not going to lose anything. Neither is the futures contract, really, because they took the 2.5% as insurance. So basically, who loses? Well, nobody really loses, but the policyholder doesn't earn a rate of return that year. So the way that this is, the idea behind this is the policyholder is saying, I'm willing to accept a 0 if the index is negative for the potential of making more than 2.5% on the upside. And then the insurance companies came out because of the fact that these future contracts on the S&P are so expensive. And they basically said, hey, we're going to create indexes that are not as volatile as the S&P. Now, I know this can be a very, very difficult topic to visualize, listening to on a podcast. So let me kind of just sum it up here. And then if you wanted more information, we could get it to you on an individualized basis, and I'll tell you how to do that. Okay. Number one, why would you ever do a fixed index annuity? It's because we want an alternative for a lifetime income, or an alternative for a safe money accumulation vehicle, meaning I can't make that much in a bond, or I've got risk in bonds, and I can't make that much in CDs or money markets. So what's an alternative? Because if we look at the fixed index annuity as an alternative to those vehicles, not an alternative to being invested in the stock market, but an alternative to being safe money accumulator, it's a good alternative. It's a way to put some of that into your portfolio. If you understand that the insurance company has got things in place that they're not going to go under if the index is down, well, that makes us feel secure. And then they're not going to keep all the profit. And so that makes them make the caps really low. The caps are based on two major things: the interest that they can earn and how expensive the futures contracts are. If you understand all those things, you understand that fixed index annuities have a place within a portfolio in some of our portfolio when it comes to planning for retirement. It may not make sense for everybody. It may not make sense for you, but for many people, they are trying to understand how they work. And that's our goal here, is to try to give you that information. Now, if you think, hey, I would like to be able to understand this in more detail, we're going to have to do that in a little bit of a one-on-one basis. So feel free to go to our website, which is pomwealth.net. And you'll see right at the top, you can schedule a 15-minute phone conversation. There is no obligation. Myself or Merce will get on the phone with you. We'll talk to you a little bit about your situation. And then we can actually show you and give you very specifics to your situation that we cannot do here on the podcast. So if you'd like to do that, again, go to our website, pomwealth.net. Go right to the top. You'll see a little button there that says schedule a 15-minute phone conversation. The calendar will come right up for you, and you can go ahead and get that scheduled. We do hope that these have been beneficial. We do have some more that we'll be talking to you along the lines here when it comes to annuities. But we hope you have found this to be of some benefit. We hope you have a great day. We'll talk to you soon.